So for the next strategy we're going to look at, it's called market neutral mean reversion or pair trading. So pair trading is actually a very popular trading strategy in the professional trading environment. So most proprietary trading firms, hedge funds are going to be running some type of pair trading strategies. Pair trading has actually started in the 80s, and it was started by Morgan Stanley. Or they were the ones who really made it popular in a way. But since the 80s, a bunch of other firms are starting doing it, and it makes a lot of sense. You'll see why in a bit here. But it's something that's very popular in the field. And ever since then, I've worked at multiple prop shops, and, most of them did, strategies very similar to this. You'll find a lot of professional traders do this. Why? Because market neutral strategies and mean reverting strategies make a lot of sense. For one, mean reversion. What does mean reversion mean? It means that things are coming back to their mean. It's not momentum. And what you'll realize if you trade for a long period of time is that most things don't have momentum. We all remember, or we all see, the Facebooks and the Amazons and, the companies that really went in one direction that had strong momentum. But we always forget all these other companies and coins or whatever that, keep going up, down, and they're just reverting. The thing is, most of the time, things just revert. Okay? 80% of the time, the markets are in mean reversion. Only about 20% of the time are they in momentum. So mean reverting strategies tend to work often. Now, market neutrality, what does that mean? Well, market neutral means being invested in multiple assets in attempt to avoid or eliminate market risk, which we've looked at. This is often achieved by being long and short assets simultaneously. So a lot of firms, what they're going to do is that they're going to have half of their money go in long positions and the other half go in short positions. Why? Because they know that they cannot guess where the market is going to be going, right? All the time. So for example, if you have some long positions and some short positions, if the market is very is moving sideways, you might make money on your longs and your shorts. If you bet on the right longs and on the right shorts. Now, the problem occurs when there's a market crash. Well, if you only had long positions, all the long positions would lose. Now, if you have long and short positions, well, you will lose on your long, but you will make on your shorts. And that way you eliminate the risk of you losing all your money if there's a market crash. And it's the same thing if the market skyrockets. If you only had short positions, well, you would just lose. But if you have shorts and longs, well, you would lose on your shorts, but you would make on your long, eliminating again the market risk. And that is why firms implement market neutral strategies, because they're in for it for the long run. And if you're trading for 20 years, well, guess what? You're going to go through crashes and, explosions. So what you want is to eliminate that market risk. So if something like this happens, you eliminate that risk away. This is why it's very popular. So then comes in the strategy that we call pair trading, which is basically a market neutral mean reversion strategy. How does that work? Okay. Well, the way it works is we come off of the concept, our philosophy for running a strategy like this is basically we can't predict when the market is going to do these major moves. And that is something that almost everybody agrees on. We can predict specific currencies or specific stocks or specific products, but the global economy itself, the global market itself is hard to predict when there's going to be a huge move. So we want to eliminate that, okay? And the other thing we believe in is that when things diverge, they converge back, okay? So to do this, we find two positions. We enter two positions, one long and one short, that have deviated from each other, and we expect them to revert back to their mean. So for example, we take two currencies. Let's say ICX, or let's say, for example, we need two currencies that make sense, that are correlated, that move together. So for example, we take ICX and Aeon, okay? We take ICX and Aeon, okay? And why do we take ICX and Aeon? Well, because maybe we know that they are very correlated. And these two coins are actually very correlated. Why? Well, because there is some fundamental reasons behind that. Maybe the team is creating this other project. Maybe this coin uses the technology from this coin. Something makes it that they're very correlated. Okay. Now I'm not going to get into the fundamentals of these two, but it could be anything. It could be that one coin is actually generating the other coin. It might be that one coin is the gas of the other coin, so it's used. So there's some fundamentals behind it why they're very correlated. Or sometimes there's no real fundamentals, but if you find correlation without real fundamentals, it's not going to be as good as something that has a fundamental reason why they're correlated. So you take these two currencies, okay, and you look at their charts, and you see that when let's say ICX is going up, you see that Aeon, for some reason, is also going up, right? So that tells you they're correlated. Now, what we're looking at two currencies like this that are moving together. And if they deviate from each other, let's say at one point, this one goes up, but ICX, instead of going up, it actually goes down, right? And let's say we start looking at the historical difference between these two. Let's say their prices. Let's say when we started here, this one was trading at $5 and this one was trading at $10. And there was always a $5 difference between them. Okay? But maybe at this point, there was a $15 difference between them. You know? Maybe this one was at $10 and this one was at 25. So looking at it like this, we kind of predict that, okay, these two currencies that are very correlated, that move together, have now deviated from each other. And if they deviated from each other, what we believe is going to happen is that they're going to converge back. Okay? So we expect them to converge back to one another. So what do? We're going to get into two different positions. Okay? We're going to get into a long position. We're going to buy this one, which is ICX. We're going to long, and we're going to go in this one, and we're going to short this one, right? Because we expect this one to go up and this one to go down for them to converge back, right? And in this way, we have a market neutral position because we're going to get into, 50, let's say we're investing 10,000 or we're trading 10,000. And we want to buy $5,000 worth of ICX. And we're going to short $5,000 worth of Aeon. So our net exposure to the market is going to be $0. We're not exposed. If the market goes up or goes down, we don't care because half of our money is betting that the market goes down, half of our money is betting that the market goes up. So, we eliminate that market risk. We can sleep well at night without the fear of market crashing. Okay? Now, a few things might happen. Well, one, the market could, the market could not do anything. Okay? The market could stay flat. Now, if the market stays flat, what do you think is going to happen? Well, maybe these things did converge, and there is a high likelihood that they converge back. Maybe this one goes up a bit, this one goes down a bit, and we find ourselves at the usual $5 range between them. So they converge back. So we make some money, right? We make some money on both of them. But other things might happen. Maybe the market actually crashes. Right? Maybe the market crashes. So if the market crashes, everything's going down. Everything. So even ICX is going to drop. So maybe we lose $5 on ICX because it goes back to $5. But you know what's going to happen is Aeon is probably going to drop so much more. And since we're short, we're going to be making money on that. So maybe it drops about, maybe it drops back to $15. Okay, so then it's at 10 and this one is at 5. They come back to where they started out at. So in this situation, if the market drops, we lose maybe $5 on one of them, and then we make 15 on the other, right? Because this one we're long, so when it drops, here, I'll put a plus here. This one we're long, so when it drops, we lose money, but this one we're short, so when it drops, we make money. So we lose some money on one of them, but we make more money on the other. So in the end, we make money, right? We make a little bit of money, not too much, but we make money. Now, what happens if the market doesn't drop and the market goes up? Well, in that situation, let's go back here. Well, in that situation, our short position, everything is going up. So our short position, we're going to lose money on it because it is going to go up. But our long position, since it's so undervalued compared to our long, it's probably going to go up faster. So for us to find each other at like that $5 range between them, that's usual. So yeah, if the market goes up, we are going to lose some money on our short position, but we're going to make way more money on our long position, right? So in the end, we are going to make money. So you see that in this situation, what we've done is we've made it that regardless of what the market does, we still generate some profit. Okay? And this is why this strategy is very popular because, all these firms, they don't want to go bankrupt if there's a huge market crash or if there's a huge market explosion. So they don't want to be exposed to any market direction. And that's why they are market neutral. And you'll see that if you research that, market neutrality is very popular. Why? Because it permits you to have stable returns. If you look at your profit and loss, you'd rather make a little bit of money all of the time, even if it's less money, than, making a lot of money, when the market goes up, and then if the market drops, losing a lot of money and have very volatile returns. And then if there's a huge market crash, you lose everything. And then we've seen how hard it is to come back from huge losses. So this is why market neutrality is very popular. So how do we really trade this, or how do we analyze this? We have a function, if you read on pair trading, and there's actually a bunch of good writers on it. The one that I like is Ernie Chang. He actually has a few books. They're more technical and some of them are automation type of books. But he actually was working at Morgan Stanley in the 80s. So if there's somebody to tell you about, pair trading, I'd recommend this guy. So to analyze pair trading, there's a function we use, okay? And this function is going to be like this. It's going to be y equals, let me just get this on here. Y equals, and then you have your first coin, so I'll call it coin A, minus your second coin, which is coin B, times the ratio of these two coins, okay? Now, why is that? Because if I don't have a ratio and I just have coin A minus coin B, then in this situation, what I'm going to have is basically here, coin A, let's say ICX, let's say Aeon is coin A, because I put it as the most expensive. Let's say this is coin A, this is coin B, okay? So Aeon is at $10. So I'll go Y equals 10 minus 5, and then the pair is at 5. Now, the problem with this is if the prices go up, if both coins go up 100%, then I'll go, Aeon is going to be $20 and ICX is going to be $10. $20 minus $10 give us 10. So then we might think that, hey, they diverged, but they didn't actually diverge because both of them went up 100%. They're still the same, they went up similar prices. So what I need to do is I need to add a ratio to take into account the difference of pricing that they have. So in this situation, the ratio is the difference between, so this is A and B, is going to be the difference between A versus B. So I'll have to do A divided by B. So my function is going to be A so coin A minus coin B, times the ratio, which is A divided by B. Okay, that's the ratio. So in our situation, what is the ratio? 10 divided by 5. So ratio equals 10 divided by 5, which is going to equal 2, right? So whenever I am calculating the pair function, which we call this the spreads, which don't get this confused with the spread between one coin. We call this the spread between the pair, so the two coins. It's sometimes confusing. So if you are market making, when you say the spread, it's just the difference between the bid and ask. But when you're pair trading, when you're talking about the spread, you are talking about the difference between the two coins. Okay. So in this situation, what I'll be doing is okay, well, the pair is going to be equal to 10 minus 5 times 2, which gives me 0. Now, if the prices go up by 100%, it'll be, and let's say this one is worth $20 minus, this one is $10 now, times 2. Well, guess what? It still gives me 0% because they didn't deviate. They both went up 100%. If for any reason, let's say this one only went up to, I don't know, $18, and the other one went up to $10, so 18 minus 10 times 2, this gives me minus 2. So now I know there's a deviation. And the deviation is that this one didn't go up as much, right? This one should have went up more. And if this one was, let's say, something different, let's say this one went up to $25, well, if 25 minus 10 times 2, that gives me 5. Again, there's a deviation. This one went up too much, and this one should be shorted, and this one should be longed. So by using this function, what I'm saying is that, look, the function gives me 0. When they deviate from 0, that means they either are too deviated or too converged, right? And I can get into a position. Because remember, if they converge too much, if they are way too close to each other, then we expect them to rediverge. So in pair trading, you could either buy this one and short this one, expect them to reconverge, or do the opposite, where you're longing this one and shorting this one, expect them to rediverge, okay? So this function here is going to be actually plotted. We're not just gonna just put it here. We're going to draw it at the bottom of the chart, okay? So what we're gonna have is at the bottom of the chart, we'll have this other chart here. And on this other chart, what we're gonna draw is the function, right? The function we just saw, y equals a minus b times ratio, okay? And here it's going to be at around 0. So you'll see that when the price is around 0 from the ratio, there's not gonna be much. But then here, when they diverge, it's going to go up. So if here, let's say they diverge $15 from each other, well, actually not 15 because we're not just looking at dollars, but if this one is at $15 and this one is at $10, y equals 15 minus 10, or let's say here is 35, okay? Let's change example, 35 and 10. So if we have 35 minus 10 times 2, that gives me 35 minus 20, which gives me 15. So here it's going to be at 15. That means they've way diverged too much. And they diverge $15 from each other. They should get back to 0. So here I would get into a short position of the pair. And when I say short position of the pair, what that means is I'm shorting the first coin and longing the second. Okay? Expecting the pair to reconverge. Now let's say at one point the pair drops to, let's say right now the prices, let's say prices keep going up, and then at one point pair 1, which Aeon, is at, I don't know, $40, and ICX is at, I don't know, $38. Well, when I put this into the function, I have y equals 40 minus, and let me actually put 35. I'll put 35 here. 35 minus 35 times 2, so minus 70. And this gives me minus 30. So if the pair drops to minus 30 here, I'll see this on the chart and I'll be like, hey, this is too low. We're too converged. I have to long the pair. And when you long the pair, that means what? That means you're longing the first currency, right? So I'm going to be buying Aeon and shorting ICX because I think either Aeon has to go up or ICX has to go down or both, but they need to diverge from each other. So this is what you're going to be looking at. You're going to be looking at another chart, okay? And this chart is going to be the graphical representation of the deviation between these two currencies. And as these two currencies diverge too much from each other, you're going to be buying one and shorting the other. If they converge too much to each other, you're going to be buying the other one and shorting the other one until they rediverge, okay? So I know it's a lot of material here, but you can read a lot on pair trading. I've read, books that are hundreds and thousands of pages long just on pair trading. It's a very interesting subject. There's a bunch of videos on it. I don't expect you to get it right away. I've done some market neutral trading for cryptos in our firm, and traders who I've taught how to do this, well, it took a long time teaching them that. It's not something that you catch right away. You have to practice, you have to test, you have to read on it, you have to rethink about it. It's an advanced strategy. It's not a simple strategy. People get trained to do these strategies for weeks before attempting them. So you have to understand that I'm teaching it to you now, but it's not an easy strategy, okay? So don't get bummed out if you have a hard time understanding it. Rewatch this video many times. Google, ask questions, do all of it, okay? But yeah, so I'll show you how we draw this function in a second here. But this is going to be very useful. Now, what type of coins are we looking at? We're looking at highly correlated coins, right? We want them to be highly correlated, so for them to move with one another. Now, we aren't just looking at correlation, because some things are correlated. And let me actually close all of this up here. Let's see if I need this correlation. Yeah, let's close all of this up. Some stocks or coins are highly correlated, but they're not very good pairs, because what correlation means is when something goes up, the other one goes up, and when something goes down, the other thing goes down, right? So I can have here, let me actually redraw this, okay? We have A and B, okay? Correlation means that when A goes up, let's say here, or sorry, I put B first. So when B goes up, A also goes up, okay? And yeah, every time B goes up, A goes up, B goes up, A goes up, B goes up. And when B goes down, A goes down. And we have all of these variables. Maybe one day A went up 2% and B went up 3%, right? And maybe the other day, B went down 2% and A went down 1%. So there's a correlation, right? And this is how you draw correlations, right? You plot all these points of how B moved and how A moved, and you look at the relationship between them. And then you can draw a slope, which is, the best fit line, we call. And the best fit line is just going to be the line that is represented by the line that minimizes the distance between itself and all these points, okay? And if you add all these error terms, all of these distances together, they'll give you about 0. All the positives and the negatives, the difference between them. This is how you find correlation. Now, correlation is not is not what you want to use to find good pairs. Why? Because some things that are very highly correlated, and now we're getting into advanced topics, by the way. some things that are very highly correlated, their correlation does not have a very good distribution. So basically, they might have some points like this. And this is not a good correlation because yes, the error terms here make it that this is the best fit line. But if you see here, basically when, let's say this one is A, this one is B, when A is going up, let's say 1%, 2%, B is going up by way more, let's say 3%, 4%. And when A is going down, okay, well, B is going down by way more, right? So if the market is going in one direction, let's say the market is just exploding up, well, A is always going to be going up less than B is going to be going up. And what that tells us is that if the market is going in a direction for a long time, well, they're going to keep diverging because B is always going to be going up faster than A. And we don't want that. We don't want that because they are going to diverge. And our objective is to not bet on what the market is doing, right? And if we don't want to bet on what the market is doing, then we have no choice than to not have something that has a bad correlation like this one, okay? Because they'll just keep diverging or keep converging. So they are impacted by the market. So what we want is we want pairs that are correlated, but that their distribution for their correlation is better, where the points here are well distributed. So yes, sometimes A is going to go up faster than B, and sometimes B is going to go up faster than A, but we can't know. If the market is going up or down, it's not going to give us a better indication of if they're going to keep diverging or not. So what we actually are looking for is for pairs that are not only correlated, but are co-integrated. Now, I'm not going to get deep into the math of co-integration, but you can read up on it. There's a bunch of books on it. There's a bunch of articles on it. To find good co-integration, you can do the Dicker-Fully test or the Johansen test. So these are the two tests. Co-integration. So you have this test that you can do, the Dicker-Fuller test, and you have the Engel and Granger two-step approach, and the Johansen test. Okay, so you have a bunch of different tests that you can do for co-integration. The reason why I'm not going to go into the math here, because I've actually learned this while I was doing part of a master's in financial engineering. So it was an advanced mathematical course, which was very, very, very deep. So the math behind it is actually, if you do the math, it's a bit complex, but you can use Excel and other tools to give you the results of these tests. Or simpler, you can just visualize it on a chart, which I'll show later. But what it does basically is it looks at these error terms here, and it checks if there's any dependence between if a error term is going to be below or above the slope based on if the other error terms were below or above the slope. So it makes sure that these error terms are independent of one another and there's no relationship. And if they are, then it's good because, then when you're looking at the pair chart, like I've talked about before, it will be, moving like this, where it deviates, converges. But when you're looking at the pair chart, the function that we've talked about of something like this, well, you'll see that sometimes it diverges too much. It keeps diverging and then it keeps converging. And we don't want that. We want something like this. Okay. Now, the reason why I talked about co-integration is that if you're somebody who loves math and you want to go deeper, you can go and do that. Okay. Now, how are we going to spot if something looks like this or not? Well, that's easy. We are going to draw it on a chart. And let me bring it up here. So the great thing about TradingView, okay? And you might have seen here that sometimes I have these coins that are 2 coins. Is the chart that we've just talked about, we can draw it here. So we said we have Aeon. Let's put Aeon USD. This is the price of Aeon USD. Well, I don't want to look at Aeon USD. I want to look at the relationship between Aeon USD and ICX USD. So what I want to do is I want to see what is the ratio between them. So this is the price of Aeon. Let me open actually 3 charts like this. Okay, Aeon USD, I'll have it here. ICX USD, I'll have it here. And then I'll open a calculator and we'll see what is the difference between their prices. So where is Aeon? This is Aeon, yeah, ICX, perfect. So Aeon first is trading at 0.090667 cents. And then ICX is trading at 0.2367409. So the ratio here is 0.38. You don't need to keep all the zeros, 0.38. So what I want to do is I want to draw a chart between this coin and this coin. And I can draw this here. I'll remove this. I can draw it all on one chart. I can go here and say, hey, I want to draw Aeon USD, okay, minus ICX USD, then times the ratio, which is 3.38. And this here is going to draw, here we go, this here is going to draw for me the chart that I just looked at, that I just drew on top of, below the other charts. It's going to draw for me the relationship between Aeon and ICX. Okay, and I see here, this is the relationship. I can put a 1 hour chart, and this is the relationship between both. Okay, this is Aeon by itself, this is ICX by itself, and this is both of them. I can see here when Aeon went up, ICX went up because they're correlated, but here I see that it's very stationary, right? And stationary means that when one goes up, they come back down. So the relationship between them keeps changing. And on a stationary product like this, right, you can see they keep moving up, coming back down. If I add an indicator like Bollinger Bands, look at this. Look at this. Every time it goes below the mean, comes back down. Goes back up, comes back down. Goes back up, goes down, comes back up. Goes down, comes back up. What I'm looking at here, this chart, is basically this here. This at the bottom. I'm looking at the function, right? I'm looking here at y equals a minus b times r, right? I'm looking at the pair function. The output of this is drawn here. And by looking at this, I can know if they diverged a lot or if they converged a lot, okay? And in this situation, I can look at it right now and be like, okay, well, right now, right this moment, they're, you know, they're a little bit diverged, not too much. I need to buy Aeon and short ICX. I would wait a bit more, but I know that Aeon minus ICX times the ratio is now giving me something lower than the mean. So they're a bit diverged, okay? Actually, Aeon is the first one, so we have Aeon. Yeah, so basically what you want to make sure is when it's dropping here, and we can look at any of these. I can actually, we'll go through some examples in the next lecture. But yeah, you have both of your charts, you know that they're correlated, and then you draw another chart that shows you the relationship between them. See, because you have here, I can draw both charts here as well, actually. So let's actually put them in one. I have Aeon here. Let's put a line chart. This is Aeon. I'm going to compare it to ICX. Okay, USD. And here's ICX. Okay, so you see here that I have both Aeon and ICX in one chart. Why can't I? let's put this here, right? I can draw A on ICX on one chart. You see that these are correlated, right? You can see that. Okay, when they deviate from each other, they reconverge back. So what you're doing is you can short this one here, or you can short this one, buy this one, and then when they get back together, you short this one and buy this one. And when they rediverge, you short this one and buy this one. And they're going to keep rediverging and reconverging, right? Here, you can short this one, buy this one. When they come back together, do the inverse. So you have two coins that are very correlated, and you can really see it here, right? And I can put any type of chart, hourly, I can put here. You can put any type of chart, and you're going to be seeing that they're very correlated and co-integrated. So the reason why we draw this other chart that I just looked at is really because it helps us into knowing how much diverged they are or how much converged they are. Okay. So I think I've said a lot for this lecture. So let's leave it at that for this lecture, and we're going to build on top of this in the next lecture. I hope it's not too much. Re-listen to this video, ask questions, look on Google, join our chat room, ask questions in there, bounce ideas off of other traders. It's a very, it takes time for this to make sense to you, and it takes some practice, but it's worth it. So give it a shot. And that being said, let's build on top of this in the next lecture.